Okay, today we're looking at financial instruments. Financial instruments is covered in IFRS 9 initially, and then there's also a little bit in IAS 32. In IAS 32, IFRS 9 and IAS 32. You remember we did a little bit of financial instruments in second year, yeah? So at third year level, the financial instruments we're going to look at is financial assets, primarily a little bit of financial liabilities. And a financial instrument is defined as an instrument which results in a financial asset in one company and a financial liability in another, or a contract or an agreement that results in a financial asset in one and a financial liability in another. The most common example of financial instruments that work like this are debtors and creditors, isn't it? So in the one company we have a receivable. There's been a contract, a transaction where we've sold goods. So in the one set of books in the one company we have a receivable, and in the other one we have a payable. And receivables and payables are financial assets and financial liabilities. And the key thing around this definition of financial instruments is that sometime they settle in cash. So they are instruments that are there to settle in cash. So inventory, for example, is not a financial instrument, because inventory you're not going to settle in cash, you're going to use, isn't it? Or you're going to sell and then it becomes a receivable. PPE is not a financial asset, it doesn't settle in cash, it gets used. So financial assets or financial instruments settle in cash. There is a little technicality that could settle in shares, but only if it's shares based on cash. So for your purposes, we're really talking about cash or settling in cash. And so cash is also a financial liability. We are going to look at a couple. Sorry, I've run out of handouts now. I'll go and make a copy. We're going to look at a couple of financial assets, and we're also going to look broadly at financial liabilities. All right. So that's just definition. When we look at financial assets and liabilities, we're going to look at initial measurement and subsequent measurement. We're looking at different categories. So for financial assets, we have shares, and in shares we have two different types, and we also have debt instruments, loans. And then for financial liabilities, there aren't really categories, it's really just the one. So financial assets, there are two different types of financial assets. We can have shares, which are financial assets, investment in shares in a company, and we can have debt instruments where we have invested in bonds, debentures, or loans. Sorry, I just want to get rid of that. So these debt instruments are bonds, debentures, or loans. And initial measurement, let me draw lines on, let me draw them a little bit faint. So we're going to look at those kinds of shares. We're going to look at debt, and we're going to look at financial liabilities, and we're going to look at initial measurement and subsequent measurement. So we're going to have a table that looks a little bit like that. Okay, so there are two different types of financial asset shares. We have the ones that we carry at fair value through P&L, and we have the ones that we carry at fair value through OCI. Fair value through P&L is the default. So when we have financial assets that are shares, the default is that we carry them at fair value through P&L. We can elect to carry them at fair value through OCI. And we can elect to do that. Can't really see that I've written the word elect. Looks like erect. Eraser. So when I have investments in shares, when I buy shares in another company, the default treatment is that I carry those shares at fair value through P&L. I'm going to talk to you about fair value, about measurement. However, I can elect to carry them at fair value through OCI. The election of fair value through OCI can only happen if it's not held for trading. So if I have shares that are not held for trading, I can elect to carry them at fair value through OCI, not held for trading. Then, maybe what I need to do, let me do this rather. I'm not liking this thing at all. I think I'm going to get rid of it. No, let me leave it. I've started it. Okay, so let's look at the measurement. Initial measurement. And really now. Move this. Okay, initial measurement for all of these is fair value. Yeah, so initial measurement for that one is fair value, for this one it's fair value, for this one it's fair value, and for this one it's fair value. We deem fair value to be cost. Because remember, the transaction is that the transaction is between two parties, arm's length, and so we assume at initial measurement that cost is fair value. But the statement says that the initial measurement is fair value. So if for whatever reason the transaction is not at fair value between the parties, we would recognize the transaction at fair value. Yeah? And we would recognize a gain or a loss. So if the transaction was between, say, related parties and it was done at below fair value, we would still recognize the financial asset at fair value. We would recognize that we paid less than fair value, and we would recognize a gain at that stage. Yeah? But initial measurement is fair value. That fair value is assumed to be cost. An initial measurement for all of my financial instruments except for one includes transaction costs. So for these three, plus transaction costs. And that's just in line with all our asset statements, that transaction costs form part of the cost of the asset, isn't it? So it's in line with what we learned in PPE. Transaction costs form part of the cost of the asset. And so, therefore, when we are dealing with... move that. Okay, doesn't want to move. I wanted to move it slightly up. So initial measurement is at fair value plus transaction costs. And the only exception is at fair value through P&L, because when we measure at fair value through P&L, we put no transaction costs in. Transaction costs here go to P&L. No transaction costs, the transaction costs go to P&L. See if I can move those up a bit. Come on. No, it doesn't want to get to separate now. Transaction costs there go to P&L. So initial measurement on all my financial instruments are at fair value. If I have an investment in shares and those shares are held for trading or they default to fair value through P&L, then I measure those at fair value with no transaction costs. Everything else is at fair value with transaction costs. Subsequent measurement. For shares, subsequent measurement is fair value. For the first lot of shares, for fair value through P&L, it goes through P&L. So in other words, the changes, let me not say through, changes in fair value go into P&L, and they will land up as other income or other expenses. Other income or other expenses. Yeah, I thought so. When it's at fair value through OCI, it goes, the changes in fair value go to OCI, other comprehensive income, and they land up in a mark-to-market reserve. Yeah, and this you remember from second year. We did these in second year, where we had shares held for trading, shares not held for trading, and ones landed up through OCI in a mark-to-market reserve, the other ones landed up in P&L, and we carried those at fair value. We now have debt instruments, which we didn't do, I think, at third year level. I can't remember doing them, but it's possible that we did. For debt instruments, there are two tests that we need to look at when we're looking at subsequent measurement. The two tests are the cash flow characteristics test, the cash flow characteristics test, and the second test is the business model test. These two tests, the first one means, can I determine cash flows and timing of cash flows for the instrument? So if I have a bond, a debenture, a loan, do you agree in most cases I will be able to say, I will pay interest this many times in this manner, and at the end I will repay the capital this much, isn't it? So I can determine the cash flow characteristics of that bond, debenture, or loan. The second test, business model, is about management's intention to keep those bonds, loans, debentures to maturity. So it's about the intention to wait to get the interest payments, wait to get the capital back. Remember, we're looking at financial assets there, not financial liabilities. Financial liabilities are done here. So financial assets, this is an investment in loans, an investment in bonds, an investment in debentures. And so the question is the management's intention to keep those loans, those bonds, those debentures to maturity and keep collecting the cash flows according to the contract? If the answer to both of those is yes, then we use Amort. And I'm going to show you how to Amort. I use the Amort method for subsequent measurement. Amort means I work out an effective interest rate and I calculate capital and interest payments over the period, and that's how I account for that debenture or that loan. And that is how we account for loans, isn't it? From second year when we did loans, we use this method where we account for interest and we account for capital. The reason that we're going to land up with an amort that might be different from just the loan is these transaction costs. Because the loan might have said, for example, there might have been a loan for, say, 5 million rand, and maybe the loan pays interest at 10% per annum and pays the 5 million rand back at the end. And it's 5 years. Yeah? So that's a straightforward loan, isn't it? If you had to do the calcs for it, you would put interest of 500,000 in every year, and then you would put the 5 million as a repayment at the end, isn't it? Straightforward. However, because now we say, no, we're going to include transaction costs in that loan, we're going to put the transaction costs in there. Maybe it's 20,000. Now our present value is 5020. Our payments of interest are still only 500. Do you agree? Our future value is still 5 million. So we, sorry, those are cash-ins. So when I bought this debenture or this loan, that's what I paid. I paid 5 million to the person I lent the money to, plus I paid 20,000 to the lawyers and whatever. So I paid that. This is what the inflows will be over 5 years. The interest rate at 10% is not going to balance that, isn't it? So we have to work out an effective I. And then we have to amort it. And what will happen is that this 20 of interest is going to be amortized over the period, essentially. So our interest is not going to be 500. It's going to be 500 plus a bit of interest. Because I need to get my loan from a debit in the beginning of 5020 to a debit in year naught, to a debit of 5 million in year 5, so that when I get paid that 5 million, it settles and disappears, isn't it? And the only way to do that is if that 20 disappears over the 5 years. And so you'll see that we need to work out a new effective I so that we can amortize, and we will be amortizing that extra 20 over the period, essentially. So let's just look again here at the different categories. Your different financial assets are predominantly shares, investments in shares, or debt instruments. Share instruments default to fair value through P&L. If they're not held for trading, we can elect to carry them at fair value through OCI. They need to tell you in the question that management has elected to do that. It's not a required. Management can still have a share that they're not holding for trading, that they're holding long term, a subsidiary, let's say, shares in a subsidiary, they can still choose to have carried it at fair value through P&L because it defaults to fair value at P&L. But if they elect fair value through OCI, then all that means is that the movements go into OCI and go into a mark-to-market reserve. It also means that in the initial measurement, I include transaction costs, whereas here in the initial measurement, I take the transaction costs to P&L. Any movements also go to P&L. Okay, then our debt instruments at fair value plus transaction costs at beginning. Then we do the tests, 2 tests. The 2 tests will tell us if we meet cash flow characteristics and business model or not. If we do, we carry it at amort. If we don't, we go back to default, and default was fair value through P&L. I think fair value through P&L. Yeah, is the alternative. Financial liabilities are almost always carried at amort. Yeah, financial liabilities are loans. I owe a loan, isn't it? They're almost always carried at amort. The only exception would be if it was financial liabilities for trading. But we're not going to come across financial liabilities for trading. Financial liabilities is capital for your business, isn't it? Your plan is not to trade it. So predominantly we will see financial liabilities being carried at amort. Okay, so that's the initial measurements. We're going to look at some examples. In the exam, they like to ask journals for this one. It's not masses of marks. And yeah, we're mostly looking at some financial liabilities and some shares, usually. But I'll show you a couple of examples from past exam papers so we can practice a little bit later today. All right, so we're going to start off by looking at some examples in your study guide. The first one we have is a financial asset through P&L. It's on page 30. It's in Title Letter 102. 102. So it's not your main study guide. It's Title Letter 102. It's not in that study guide. You don't have? Okay, you'll have to just read it off here. Title Letter 102 in your... I don't know why they sent it as a separate title letter, but that's what they did. So it says, A bought 100 shares in B when the cost was 10 Rand a share on the 29th of December. Costs to finalize the transaction were 50 Rand. So I like to draw timelines. So here I have 29 December. I bought 100 shares at 10 Rand a share. And costs were 50 Rand. Okay. Then the share price at 31 December, and I presume that's my year end, was 10 Rand and 2 cents. The price on the 1st of Jan was 10 Rand and 3 cents. And at that date, the amount was paid by A to B. The shares were part of A's trading portfolio. So this is important. It was part of the trading portfolio. So remember what we say when we have shares. The default is fair value through P&L. But if it's not held for trading, they can elect fair value OCI. This one is held for trading. And they didn't say anything about management electing OCI. So it's not OCI, right? It's fair value P&L. So therefore, fair value through P&L. When it's fair value through P&L, these initial costs must be written off to P&L, isn't it? That's the rule. So we look at the journals. On the 29th of December, I bought shares at 10 Rand, 100 of them. I debit investment in shares and I credit a liability. I haven't paid for them yet. They didn't put the 50 Rand in, but at that same date, you would say, debit other expenses in P&L. Let me say expense. Debit other expenses in P&L and credit bank when you paid that 50,000 or 50 Rand of costs. Then there's a movement from the 29th of December to the year end. The movement is 2 cents. Yes, from 10 Rand to 10 Rand and 2 cents. That 2 cent movement, we're going to times by 100 shares. It gets you 2 Rand. It's an increase in the value of the shares. So I do a little arrow up. I debit investment in shares with the 2 Rand. And I credit P&L. Right? My fair value change goes through P&L. Profit on trading portfolio in my P&L. It goes in other income. Yeah? Fair value measurement, profit, whatever you want to call it. Then, on the 1st of January, I settle, I pay the 1,000 Rand. Debit liability, credit bank. What they've also done on the 1st of January, and I don't know if it's really necessary to have done, is they remeasured again. So they said another 1 cent up. and then they remeasured it again. But usually when we remeasure, we only remeasure at the year end, isn't it? Otherwise, you could be remeasuring every day. What some companies do if they report monthly is they might remeasure monthly, or they might remeasure. I know that, for example, bigger companies listed in the US, they have to issue quarterly reports. Every quarter they have to issue interim financial statements. So they will measure quarterly. Yeah? In South Africa, listed companies have to report every 6 months. Interim reports every 6 months. So they would measure every 6 months. You wouldn't go and measure every month if you only need to measure every 6 months, unless there was a big movement, isn't it? And it would have affected your P&L. Then I suppose you would want to report it that way when you do your monthly reports to management, so that management is aware. Yeah. So there's your journal. Looks easy enough? Easy enough. You're going to practice one. It's an exam question. You can see already also how the exam questions work. It was an exam question. We can see when, because here's the year end, 2012. In 2012. It's for 10 marks. That's more or less how much these financial instrument questions are, right? It's not masses of marks. They're about 10, 7 sometimes, 10 marks. And they ask you to prepare the journal entries, cash transactions included, to account for the above transactions in the accounting records of Bedazzle for the year ended 31 March. And they say to you that Bedazzle bought some shares on the 30th of November. Do your timeline. Yeah, here's your dates. It's important with this section of work to keep track of dates. My year end is March. I bought the shares in November 11. I settled or paid for them January. And then my year end is March. So those are my bounces, isn't it, that I have. We acquired 600 shares from a broker at 9 Rand per share and transaction costs of 600. The Bedazzle will settle the account with the broker in January. The broker charges interest at 10% per annum. Assume that 9 Rand, that the transaction costs, we also pay the broker. Okay, so if you don't get told, assume that usually the way it works is you deal with the broker, you pay him all the transaction costs, and he pays if he has to pay whoever. Yeah, you're not dealing with 1 million people. So assume that you owe the broker for the 600 shares at 9 Rand a share plus the 600 Rand. Assume that. At year end, the market value of the shares was 11 Rand. The shares are held for trading. They are not held within a business model with the objective to hold shares to collect contractual cash flows. Although that would only be debt instruments anyway, but in this case, they are held for trading. So you know what held for trading means. It means fair value through P&L, which means the fair value movements go through P&L. It also means that transaction costs get expensed. 10 marks for journals. It should be, if you see this in an exam, you should be going, yay, 10 marks, done, down, isn't it, finished? Okay, let me see those journals. Okay, so our initial transaction, at the 30th of November, we record that we've bought shares at 9 Rand. We record a transaction cost, which goes to P&L, yes, not included in the cost of the shares. And we record that we owe the creditor that money, 6,000 Rand. Then, to the 31st of January, we have to put in interest. They said you have to pay interest at 10%. You pay interest at 10% on the 6,000, and you pay it for 2 months. 100 Rand of interest. And then on the same date, you settle. Pay the creditor, bank. Yeah. They say you could have done that all in one journal, but I do like to see separate journals, isn't it? So first booking the interest, then paying the creditor on the 31st of January. Then at the 31st of March, our last journal, which is then to recognize the gain. The gain is 2 Rand a share, from 9 Rand to 11 Rand. 2 Rand a share times my 600 shares. 1,200 rand. It's a gain. It goes to P&L. You see, this time they call it a fair value adjustment. It doesn't really matter what you call it, as long as it is clear where it's going, and we increase the value of the investment. 10 marks. Easy marks. I think so, isn't it? Easy marks. If you get this one, it's nice and easy. It's a very easy 10 marks. Done. Okay. Then, the next example we're going to look at is example 6. Oh, you guys don't have the TUT letter, isn't it? And example 6 is one where we're looking at a financial asset that's carried at Amort. So here is my information. I'm going to work through it with you, and then I'm going to let you try and do, well, I'm going to help you, and then I'm going to let you figure it out. On the 1st of January 2009, Mon purchased a discounted bond and paid 914,350. So 1 Jan 2009, I bought a bond at a discount, and I paid 914,350. If the date of maturity is 31 December 12. What I like to do is then figure out the period of the loan. This is year 0. So December 2009 is year 1. December 10 is year 2. December 11 is year 3. December 12 is year 4. Yeah? 4 years. 9, 10, 11, 12. The following details are applicable to the bond. The bond has a market rate of 15%. This market rate of 15 is what led to the discounted price. Yeah? But we don't use market rates to do our calculation. We assume that that market rate led to this discounted price, and so therefore, I wonder if I can actually prove it. Let me check. Yeah, look. This bond, let's just carry on, pays a coupon of 12. What a coupon means is that this is the interest payment. Coupon is to calculate your interest payment. So the face value, the future value of the bond is R1,000,000. So in 3 years' time, 4 years' time, I'm going to get R1,000,000 cash in. I paid 914,350 today. I'm going to get R1,000,000 back. And every year, I'm going to receive 12% of that million, 120,000 rand of interest. If I take these cash flows and I discount them back to today, you will see that the interest rate that you're going to get is 15%. Yeah? So, but we don't work with that. We try and work out an effective I. So what we know is cash flows, isn't it? Remember, this was a bond. I said to you, one of the tests is that cash flow characteristics test. And so therefore, what we know is cash flows. These are the cash flows that we know. We know that this is the present value. We know that this is payment. We know that this is future value, and that this is N. So we calculate an effective I, and then we amort. When we amort, we will get, for every year, a mix between capital and interest. And look, we're looking at the fact that our capital needs to grow from 914,350, I'm going to recognize an asset at this stage. Do you agree? I bought a bond. I'm going to say debit investment in a bond, 914,350. This 914,350 needs to grow so that in 4 years' time, it's R1 million. Because that's what I'm going to collect in 4 years' time, isn't it? And then when 4 years' time gets here, then the entry will just be debit bank credit bond R1 million, and it's gone. So this 120 that I'm putting through as interest every year, is going to have to be split between capital and interest. It's not all going to be recognized as interest because some of it needs to make my investment bigger. In fact, it will be more that will be recognized as interest, isn't it? So this is payment. This entry is bank. It's debit bank, isn't it? I receive 120,000 Rand. I'm going to have a debit which will go to this bond to make it grow. And I'm going to have a credit to interest to balance it. Okay, so try and do the Amort for me and tell me what is your first year's Amort numbers. You all know how to do Amorts on your calculators? Okay, financial calculators, Amorts. So you first put in the blues. Present value minus 914,350. Payment plus 120. Future value plus R1 million. You must start to work with cash flows as the pluses and minuses on your calculator. I know that in first year you kind of learned to do just this is always a minus, that's always a plus, but it's not always going to be the case. In our case, payment and future value both are cash in, and that 914 is cash out. So make that a minus, make the others a plus, make N4, calculate I. Your I should come back at 15. Which is how they got to this price. They got to this price by saying, the market pays 15, you only want to pay 12, I can't pay you R1 million, I have to pay you less to make up for it. And so now you're going to take that and you're going to do an Amort. So year one's Amort. Pearl, I think you've already done it. What's the number? The interest amount works out bigger than 120. And the capital piece then is 17,152. Is that right? Yeah. 17,153. Does it work out to a 3? Then this works out to a 3 as well. Okay. My little toolbar disappeared that I used to have on the side there. Okay, I want to see who's managed to do that. Everyone? Sazi? No? What calculator have you got? The Sharp? Cassia? Oh, the Texas. Okay, I'm going to try and come help you, see if I can remember it. On yours, once you've got the 15, have you got the 15 yet? Okay, put in the numbers at the top here, and then ask for I. Okay, so those of you that have got this, you can complete your Amort. So for every year, I want you to just make a note of those numbers. And then I want to see if you can do the journals. Remember the journals are, I start paying 914,350. Then for 4 years, I will receive 120, debit bank. When I debit bank with that, I'm going to credit interest received. But my interest received is going to be the amount on your Amort. And the difference is going to go into my capital. And you're going to do that for 4 years. And then when you've done that, I want you to see what your balance is on your capital, because it should be R1 million. And then you can settle it. All right. So those of you that can't do Amort. Oh, okay. Then you do the. So I want you to do basically a little Amort table for me over here, where I want you to do capital and interest for the 4 years from your calculator. And year one we've done 17,153, 137,153. Okay, I want you to do the 4 years. Okay. Okay, did you get the IS 15? Okay. Why are you? What is that? ALG, algebra mode. I don't know why you have so many things. Is there clear?
Isn't this the same as yours?
Yeah, it is. Future value, payment, in PV. There it is. What had you done? Did you put your PV in as a minus?
Yes.
Okay, try it again. Try it again. You need to get that first bit. You've got the 15%?
Yes, I do.
You did? Okay, then you amort. There's an amort button somewhere.
Yeah.
Okay, then you amort. Period 1 is 1. Period 2 is 1. So what I'm getting there is year 1. Only year 1. Beginning year 1, end year 1. Okay? There's your balance. There's your capital. There's your interest. Okay, then if you want the next period, you go here where it says P11 and you make it a 2. You say 2, enter. And then you say period 2, 2, enter. And then you say there, principal, interest. See? So I'm just going to put it back to 1 so that you can practice or you can get the numbers. Did you get that? Kind of. Okay. You fine with the morting? Yeah, you were fine with the morting. You, Nikita, fine. Did you get the 15? 4. Did you put 4 as N?
Yes.
There you go. Okay. So now there's your mort. You see it up there? So you're going to say 0N, 1N, just to go from period 0 to 1. Yeah? And then you go orange, amort. So that gives you the interest. And then when you say XY, it gives you the capital. Interest, capital. Okay? Then to get your next period, you just go 1N, amort, it gives you the next one. 1N, amort, it gives you the next one. When you do that, the total of your capitals the total here of your capital amounts should be the difference between the million and the 914.35. I think it's out by rand. 85,650. Because that's what I'm going to do, is I'm going to keep putting that number into that capital. And at the end, my capital will be 1 million. So I want you to try and do the journals. I want you to try and do the journals for me. At 1 Jan, at December 9, December 10, December 11, and then December 12. Okay, first journal, when I buy the bond. Journal 1, 1 Jan 09, I buy the bond. Debit, investment in bond. Credit bank. Then my journals for your payments, for your installment, is to debit bank with 120. Credit interest, and then debit capital. My capital needs to grow for each of those years. So just think about what happens. I'm receiving 120,000 Rand. I debit bank. My amort table says I must record a certain amount for interest received. I credit interest received. Remember, I bought a bond. I'm going to earn interest. And then the balancing figure goes to the bond. And then right at the end, I settle. I settle the bond. I receive the 1 million Rand. First journal?
No, the one for the
for the installments?
yeah, for the installments, what is it
This is debit bank. And then this is credit interest received. And then you're missing a debit because it won't balance, right? And the debit goes to the bond. Because my bond is going to grow. My bond starts off as a debit of 914,350. Needs to end on R1,000,000 because that's what I'm going to collect in 4 years' time. That's what the purpose is of an amortization, is to get your capital balance from what it is today to what it will be at maturity. The amorts that you've seen maybe until now were on leases where our balance at the end is a 0. So your capital keeps dropping. But this capital needs to grow. It needs to grow from 914 to R1,000,000. Okay, so here are the journals. Our first journal is to record a bond, 914,350, and the other side is bank. Then for the next 4 years, our journal is to show bank at 120. I received 120 in cash. It was my interest, so to speak, that I'm receiving in cash. But according to my amort table, my interest amount must be 137,513. And so there's an amount that goes into the bond of 17,153. The next year, as my bond amount is growing, do you agree? My initial amount was 914,350. If you do 15% on that balance, that's what gives you the 137. Yeah. Then the next year, the amount grows. So it goes from 913,350 plus the 17. Here we see it's on the amort. I start with 914, and then the amount grows to 931. And then I start with 931. Interest at 15% is more now. So the capital piece is more, and the balance grows. And now it grows to 951. The interest on that is more, and so it grows. It goes to 973. And then the interest on that is more, and it grows, and it ends on R1,000,000. Yeah, that was what I wanted to do, end on R1,000,000. The interest will keep growing because my balance is growing each time. So interest in year 1, 137, interest in year 2, 139, interest in year 3, 142, interest in year 4, 146. The balancing figure going to the bond, isn't it? So the difference between interest in your amort and cash always goes to capital, isn't it? In this case, the capital is a bond. In this case, the balance is a debit to that bond. On maturity, we settle the bond. It has now grown to R1,000,000. You can see on the amort table. And so now it gets settled and it's gone. Yeah. So that's an example of an amort. We are going to deal with, in a little while, debentures or bonds issued by the company. It's the other side of the coin, isn't it? So in this one, we bought a bond. We're going to look at when the company issues a bond or issues a debenture. So we're going to see an amort table from the other perspective. And that's the one they prefer to ask in exams. So when I was looking through the past exam papers, I didn't see any where, well, there must be some, but in the one book that I was looking through, I didn't see any where they actually asked for an investment in a bond or an investment in a debenture. But there are lots when they ask about when you issue a debenture or issue a bond. So we'll look at that. Example 7, I just wanted to touch on quickly. It's shares. They should have been a bit clearer on the shares. They say that, oh no, it's the same thing. I'm not even going to look at it. They're held for trading. Look, they go to P&L. Okay, so that one is not one that I want to look at. I want to talk about IAS 32. IAS 32 is an old standard. It's still there a little bit. It hasn't yet quite been replaced yet by the IFRSs. IAS 32, you've got one? And I don't have enough. I have 2. So this time it's Pearl that doesn't get one. I'll make a copy for you, Pearl. When I should have gone down now when I was just waiting for you guys to finish. IAS 32 deals with the distinction between capital or liability? Capital, equity or liability, let's say that. Or equity versus liability. And what IAS 32 basically says is that it says that an instrument, so it deals with issued instruments, IAS 32, issued instruments. And it asks the question, these issued instruments, are they capital or liability? And the two main ones that we're going to look at that could be one or the other. Because do you agree, share capital, these are the different types of issued instruments. Ordinary shares, preference shares, and debentures. Yeah? And if we look just at those, sort of at a very basic level, usually your ordinary shares are equity, and your debentures are liability, and your preference shares could be one or the other, isn't it? But today we're going to look at the instance that debentures could also be one or the other, especially convertible debentures. For preference shares, the preference shares that we consider to be equity are non-redeemable or convertible. Non-redeemable or convertible preference shares are considered to be equity. Redeemable preference shares are considered to be liability. Yeah? So this is what this whole question is in IAS 32. When the company issues instruments, and maybe I should move that here. When the company issues instruments, those instruments are ordinary shares, pref shares, and debentures. Are they equity or are they liability? The rule is that if the company cannot avoid paying cash, then it is a liability. If the company cannot avoid paying cash, then it is a liability. Else, it's equity. So liability comes first. We first rule out liability. If we can rule out liability, what we are left with is equity. Yeah? So that's the general rule in IAS 32. IAS 32 is all about the instruments we issue. Ordinary shares are never liability. Yeah, so there I'm going to put a cross. But preference shares could be liability or equity. You know, in second year or in MAC, we talk about these preference shares, talk about them as being, what do they say? Now the word escapes me. They are instruments which can be one or the other. There's a word they use for preference shares. Hybrid, that's it, hybrid instruments. So preference shares are referred to as hybrid instruments because they could be equity or they could be liability. It depends how you set it up. Debentures. Debentures are usually liability, but do you agree that if the debenture is convertible into shares, there could be a piece that is equity, isn't it? Because they're going to convert into shares, especially if the conversion is automatic. And so today, IAS 32, we're really going to look, mostly our calculations are going to be focused here on the debentures. So most of our calculations are going to be focused here on the convertible debentures and how much of that debenture is equity and how much of that debenture is liability. But we're going to start off by lecture by looking at these preference shares. I have seen in one exam a little question where they asked you about the preference shares. And so in example 8, that you don't have in your handout, Untitled Letter 102, they go through a couple of different types of preference shares and they ask the question, should these be equity or liability? So let's just look at them. Lula Lee issued redeemable preference shares. They're redeemable at the option of the shareholder. And if the options are not exercised, they automatically will redeem. So the question, remember, was can the company avoid paying cash? Can the company avoid to pay cash? No, they can't, isn't it? So therefore, it's a liability. This preference share is going to be redeemed. The preference shareholder has the option to redeem this share, to put it down and say, can I have my money? If he doesn't exercise that option, then on the 31st of December, it will automatically redeem. So the company doesn't have the option to avoid paying cash. It will have to pay cash. And so therefore, the preference shares are a financial liability. The next example they have is Lula Lee has 1,000 redeemable prefs. Lula Lee has the option to redeem these shares at any time. At any time. So look now who has the option. I just want to see if they said anything else. The option now is with the company, with Lula Lee, isn't it? They are redeemable, but at any time they can redeem them. So they can choose to never redeem them. Do you agree? So can the company avoid paying cash? They can, isn't it? By just not redeeming them. So because the company can avoid paying cash, they don't have a present obligation to transfer cash. Therefore, it doesn't meet the definition of a liability. And so therefore, it will be equity, that one. Example 10 is convertible preference shares. Convertible preference shares will be converted to shares. Again, can the company avoid paying cash? In fact, there's nothing here that says the company has to pay any cash. Do you agree? So yeah, there's no cash whatsoever. They're going to convert. And so these ones are also equity instruments. Yeah. So you could get a little small question about that. The one that I remember seeing, I think was one that we saw in a question that we did, I can't remember now, was one where it was actually a framework question, where they said, according to framework, tell us whether the preference shares are a liability. And you just have to say, is there a present obligation to, as a result of a past event, and will future benefits flow, isn't it? And for these, like for this one with the convertible, the answer is no, isn't it? For the one where it's redeemable, the answer is yes. So we're almost going back to framework to look at the definition. And what IS 32 says, right at the beginning, we talked about it, basically says, check first if you have a liability. If you have a liability, then the company cannot avoid paying cash. In that case, it's a liability, it's not equity. But if you can avoid paying cash, if there is no future outflow of economic benefits, then it's equity. Okay, so that's the story with the prefs. So now we then are going to move on to the debentures. So let's talk about the debentures. And we're talking about convertible debentures. Convertible debentures in IAS 32 are called or considered to be compound instruments. Compound instruments. What does a compound instrument? A compound instrument is an instrument that has a liability component and an equity component. When we are looking at IS 32, IS 32 says, first, look for the liability, doesn't it? So what is the liability component? The liability component is the present value of the future cash flows. Those cash flows are interest payments. According to your contract, you have to pay interest on the debentures, isn't it? That's how a debenture works. It's like a loan. And then it may or may not have a future value, which is the redeem amount. Now, that future value may be null. Could be null. If the debenture automatically converts. If the debenture is going to convert automatically, then that redemption amount is null, isn't it? There is no option anywhere to convert or to pay cash at the end. That debenture will convert. So then in that case, that amount is null. We first work out the present value of the future cash flows, and we do it, let's say rather, we use, I think even that, we use Funny that. A market I. We use a market I to do that calculation. They will have to give you a market I in the question. And we use a market I to calculate the liability component. Once we've worked out the liability component, the equity component is the balancing figure. Okay, so I'm going to take you through an example, and then you're going to practice 2 exam questions that are to do with equity components. All right, so the example, I was going to say is on page whatever, but it doesn't matter because you can't see the page. Here's a debenture. The entity has issued 2,000 convertible bonds at the start of year 1. The bonds have a 3-year term, and they're issued at a face value of R1 million per bond, giving proceeds of 2 million. So do you agree that 2 million is what I'm getting as cash in the beginning? So this 2 million is what I need to split into the liability component and the equity component, the 2 million. Interest is payable annually in arrears at 6%. So 6 times 2 is 12. Is it 120,000 rand? I think so. The payment is 120,000 rand. Each bond is convertible at any time into 250 shares. When the bond is issued, the prevailing market rate is 9%. Where does it say what when it ends? Issues at the end of year 1, a 3-year term. There it is. N is 3. No, let's fix that. N is 3. And then they say to you, when the bonds are issued, a market interest rate for similar debt with no conversion. So if it was just liability, then market I is 9%. Yeah? It says each bond is convertible at any time, but if it doesn't get converted, then I have to pay the 2 million rand, isn't it, at the end? So it should be a little bit clearer, but each bond is convertible at any time into the shares, but if it's not converted, then I'm going to have to pay the 2 million rand back. So I calculate a liability portion. The 120 and the 2 million go the same way, isn't it? It's cash out. I've issued, I now pay. I pay interest, I pay the capital back. So if I put this as future value, this as payment, this as N, this as I get a PV. Work it out for me quickly. It should be that PV, 1544. Just check. Future value 2 million, payment 120,000. N3, I9, PV. Yes? No? Doesn't work. Oh, it's not that. It's that 184812. They've done the 2 calcs separate. 1848 122, is it? Or 123? 122. 1848 122. Which means then if I take the 2 million off, that the equity piece is therefore 151,878. Yeah? 151. Now, on this bit, you have to amort. It's exactly the same thing we did just now with that bond. Look, I have a liability that I'm going to recognize when I issue the 2 million debentures. I'm going to say, debit, bank, 2 million, because they're going to pay me 2 million. And I'm going to say, credit liability component, 1848122. And I'm going to say, credit equity component, 151,878. On the liability component, it needs to grow. It needs to grow here. It's going to start at 1848122, but it needs to grow to 2 million, isn't it? So I'm going to have the exact same story that I had earlier, but the other way around. So if you still have the numbers, if you haven't gone clear all, you can quickly amort for me, and you should see an amort that looks like that. $166,331 is your interest, your first interest, isn't it? And your payment is 120. So then the difference is your capital. And you'll see my capital growing. So I start with capital of 148,122, and the capital will grow, and it will end on 2 million. Let's look at the journal entries. They're exactly the same journal entries that we did when we did the debenture. This is the one they like to ask, except for your first entry. Your first entry is, I've issued a bond, and I need to split liability and equity components. So here is the split of liability and equity components. Equity, liability, and back for the 2 million. Yeah. Then the rest of it is the amort. But my amort is backwards now. I'm paying interest. And I am paying bank. And the balance is going to the liability. Yeah. Interest, bank, liability. Interest, bank, liability. And that will happen for the 3 years. At the end of the 3 years, I will have the 2 million sitting in my liability. Do you agree? At that stage, then, if the shareholders have done nothing, I will pay them out. If before that stage the shareholders convert their shares, or at that stage they convert their shares, I will take that liability and I will use it to issue shares. But that piece we don't normally see in this module. There's an extra penalty, let's say, when there's a convertible instrument and then you have the choice, maybe as the company, to convert or not convert. And then if you choose the more expensive option, they make you put an amount in your P&L. So it's not quite that straightforward. But otherwise, we see it as just straightforward like that. Yeah? So these entries are looking familiar. They're the opposite of the entries we had before. Do you agree? Okay. Here they have those entries. Sorry, they are here. It says, if the holder wishes to redeem the bond, then the entry is debit liability credit bank for the 2 million. If the holder wishes to convert the bond, then I take the liability to share capital. Yeah, because now it's equity. I don't recognize it as income or whatever. I just take it. And the other 151, this other 151 here, the one that we had originally said was equity. That 151, in the statement of changes in equity, you can just transfer it. Because at the moment, you're calling it a bond, isn't it? It's equity bond in your statement of changes in equity. When the bond is disappeared, you either can take it to share capital or you can take it to retained earnings. The statement says it doesn't matter. You're keeping it in equity, isn't it? So you can stick it wherever you like. Okay, so, but this side goes to share capital because there's 2 million rand on our shares. Example 12 deals with automatically convertible debentures. You'll see that the only difference with automatically convertible debentures is that, is it the same information more or less? Yeah, it looks like it's the same information, isn't it? Because it's still, the only difference with automatically convertible debentures is that when we're taking this 2 million, our future value is now null because they're going to automatically convert. There will never be any future value cash paid. I can avoid that, so it doesn't meet liability definition. So when I'm doing liability, I'm just going to have a payment of 120 for 3 years at an I of 9. And when I PV that, then I get this 303,755. And then the balancing figure is the bigger number, becomes your equity number, the bigger number. Yeah, the balancing figure. And then I amort this 303. And this 303 needs to disappear completely, isn't it? Because look, my future value is null. FV, null. Because my future value is null, this needs to disappear. So I start with a credit, but it needs to disappear. So I need to keep debiting it. So what's going to happen is that now my interest will be smaller than the 120 to make it disappear. Here's the amort. I start with 303. It becomes 0 So when I pay interest of 120, I'm actually only going to show small amounts of interest, do you see? Just to make that 303 disappear. Yeah. So even though I'm paying 120 on the bond, I'm only going to show 27 as interest. And now it's not a credit to the liability anymore. Now it's a debit to the liability to make it go. So now here we see the entries: debit bank, credit, equity, and liability. But now my equity is very big. My liability is very small. My future value is 0. And now when I do my entry for bank and interest, here's bank as interest. The other side is a debit because interest is tiny compared to the 120. So the other side has to be a debit to balance it. Yeah. And so I start with a credit, 303,755, and I debit, and I debit, and I debit, and it disappears. Yeah. In fact, it disappears by a rand more, it looks like. And then at the end, I've got nothing left in liability. So when I issue the shares, it comes out of the equity component and goes to share capital. Okay, so we're going to practice those two, one of each. The first one is this one, question 6. It's for 11 marks. On the 2nd of January 11, Mkhana issued 1,000 convertible bonds of 15 Rand per bond, resulting in proceeds of 1.5 million. These bonds are convertible into 150 shares at the option of the holder anytime until maturity. So you can make a note of that. It's short. And interest is payable in arrears at 7%. When the bonds were issued, the prevailing rate was 9%. So this is similar to our first one, isn't it? Where conversion can happen at any time at the option of the holder. So we don't have, and if it doesn't convert, then the shares will redeem. Yeah, they should make that a bit clearer, I think, but that's, I suppose, what happens with a convertible with a bond, that the bonds mature on a certain date. At that maturity date, if you're still holding bonds, you're going to get cash back. If you've decided to convert, you'll get shares instead of cash. Okay. Right. Let's see if you can do that one. That was them. Do you agree? Equity component 75,939. Liability 1424061. You got that? Sounds like nobody got it. Yes? No? You did? Paul, you did, huh? In front? No. Liability component, future value 1.5 million. I9N3, payment 105. What did you get wrong? What did you use for payment? What did you use for payment, Christian? Huh? So, future value, 1.5 million. No, 15. Yeah. Is that right? Yeah. 1.5 million. Then the interest is 7% on 1.5 million. So 7% of 1,500. Is 105. N is 3. I is 9. Not 7, 9. So I don't know. Where did you go wrong? Use the 7, and you? Okay, remember we must use market I, isn't it? Market I for similar debt without conversion. Remember when we had it on the board, I even wrote it with like a big fat highlighter, isn't it? Market I. So you must use market I. So if you used market I there, you would have got a present value No, I'm going too far, isn't it? I think that's the next one. You would have got a present value of 1424061 for the liability. Then your equity is 75939. If you get that wrong, then everything else will be wrong, isn't it? I don't know if they will carry through. They should. That's why, even though you don't do a full amort, you still should have some calc to show me that interest number, isn't it? Like here you see they just say the interest is the 1.4 times 9%. Yeah? Or show the calc from your calculator the amort year one interest capital, so that they then can maybe give you some marks for the journal even though your numbers are wrong. So then if your numbers were wrong, your journal would be wrong, but the entry is a credit to bank of 105, a debit to interest of 128, and the difference goes to the liability, 23,165. My liability needs to grow from 1,424 to 1.5, so it needs to be a credit to the liability always. So that was 11 marks. One more chance to get it right. This next one is automatically convertible debentures. Investor Sure issued 4,900 automatically convertible debentures with a face value of 550 Rand per debenture. Interest is payable at 6.5% per annum. After 4 years, each debenture will automatically convert into shares. When the debentures were issued, the market rate for similar debt was 7.5%. So there is no future value this time, isn't it? So automatic conversion, there's no obligation to redeem. There won't be any redemption ever. It will automatically convert. So again, they want you to do for 9.5 marks this time. All the journal entries for the year end, February 14. We again are dealing with year one. So in both cases, year one. So they actually have given you the dates they want you to do journals at, 1 March and 28 Feb. And when they give you the dates, they actually want you to put the date, 1 March and put the first journal, and then 28 Feb and put the next journal. Again, 2 quick journals, do you agree? Let's see if you can do those. So you can see that financial instruments in the exam is about 10 marks. And they're very similar, one to the other to the other. So if you practice them, you should be able to get those full 10 marks. No problem. Right, let's see. Let's see if we all can say we got our first journal right. Liability component 586718. Yes? Yes, everybody, yes? So it's small, this one, hey, because it's automatically convertible, so equity will be big. The conversion is definitely happening. So then our liability is only the present value of the interest payments. So liability is small, equity is big, and this time the interest cost will be smaller because that liability will disappear, isn't it? I've created a liability that says I have to pay these interest payments, and so that liability will disappear over the 4 interest payments. But for your first year, your amort was 44,004 was the interest amount that came out on your amort table. So the difference, or the capital, actually comes out on your calculator to 131,171, balancing then to the payment of 175,175. So financial instruments is always very separate. Like we've been dealing with a lot of topics that are all like enmeshed, isn't it? We did PPE, we did investment property, intangibles, impairment, non-current assets held for sale, disposal groups, isn't it? Discontinued ops. Everything is enmeshed. We see an asset in PPE, then it's in non-current assets held for sale, or then it's in investment property, then it's all of those topics. Impairment we dealt with when we did intangibles, we dealt with when we did impairment, we dealt with again in non-current assets held for sale. But now this topic is completely separate. So you've seen in the ones I've showed you that it's a part B, a little part B for 10 marks, thereabouts, with journals. So if you get that, I think it should be maybe one that you can just do quickly, isn't it? Kill it, get it done. Then you know that you've earned those 10 marks. Because remember, the exam is to earn as many marks in the minutes as you can. What we've got left to do is Forex. That's it. We're going to do it over 2 weeks just to make sure that we are clear. We're going to deal with just normal Forex and start looking at hedging in the first lecture, and then we'll look at hedging some more in the second lecture. That will be lecture 9 and 10 when I get back from leave. No lecture next week. And then we've still got 3 weeks left to do past exam papers. and revision. Yeah. So this is about 10 marks. Forex is between 15 and 20. The other sort of 60% or 70% of your paper is that PPE stuff that we've already done. Hey? But you know that. You saw it when we were doing it. Lots of marks. The other thing that you might have seen here is no tax. We don't deal with the tax aspects of financial instruments. But it would just be capital gains, really. But we don't deal with it. We also don't deal with tax when we do Forex. So that's like a relief, eh? Shoo. Yeah. Especially Forex. There's some really like strict tax rules for Forex. But we don't deal with and see the tax on these two topics. All right. So if you wanted to start doing some past exam papers, you should be able to do them. I don't know, when I come back, we're going to really start looking at some of these past exam papers. They're tight letter. But I'll give you a pack. Yeah, Lolani's busy working on the packs. So hopefully when I get back, those packs will be just about ready and we can start working through some of those. Otherwise, tight letter 104. I'm going to say you should be getting in the mail. You can print it, yeah. So, I don't know. If you can get someone to print it at an office, it's much quicker on one of those laser printers. Otherwise, at home, on one of those ones that we have at home, it takes a bit longer and uses up your ink cartridge in one foul swoop, isn't it? But what can you do? All right. I'll see you guys I won't see you guys next week. I'll see you the week after. Enjoy your week off, your Easter break.